So my name is Naomi Francis, and with me is my colleague, Mr. Yusuf Stafford, as introduced. And today we'll be presenting on our paper investigating the finance growth nexus in the Eastern Caribbean Currency Union. So in preparing this paper, we wanted to look at the motivation behind it. So the Eastern Caribbean Currency Union, we are in a unique position, and we have one central bank, as we all know, the Eastern Caribbean Central Bank. And during our 40th anniversary celebrations, the governor would have put forward an initiative called the Big Push Initiative. How do we double the GDP of our countries over the next 10 years? And subsequently, we would have had a cascading research agenda under this topic. In order for us to know how we double our GDP in 10 years, we needed to understand what drives growth in the region. So we would have done a macroeconomic reassessment of the financial system and the development. We would have also looked to improve our understanding of financial systems and what the relationship is with growth. This paper and the research would have also helped us to identify the progress that we would have seen in the financial system of the ECCU and the future work that needs to be done. So that was some of the motivation behind us looking at this research. So how do we understand the areas to target growth? Now, the core questions that guided us are the following. How does financial development and depth affect economic growth within small financially integrated economies, which is what the ECCU is, and what do these effects reveal about the regional financial system? Does a long-run equilibrium between finance and growth persist for the ECCU? Because we are a unique quasi-grouping. How does the relationship between finance and growth impact us specifically? And we also look to investigate the direction and the mechanisms of Granger causality between financial development and economic growth, which would help in clarifying whether finance in the ECCU acts predominantly as a driver of economic expansion, or is it responsive? So today, throughout our presentation, we have taken the stance of do an overview of the ECCU financial system. So we look back, what do we know? What are the financial indicators that we look at? What are the theoretical contributions to this topic? What has changed regarding finance and growth? What we still don't know, and what do we need to do further research on in an aim to double our economy's GDP? And finally, what are some policy recommendations that would come from this? So before we start, we just want to note that financial development is defined by King and Levine empirically, and these are some of the indicators that would have been used in our econometric analysis. So we define financial development using liquid liabilities to GDP, domestic credit allocation as a share of GDP, and credit to non-financial private firms relative to total credit. So the ECCU system is unique. We are 8 island economies that share a common currency and a common central bank. The ECCU is predominantly a commercial banking sector. So the commercial banking sector is the most dominant sector of the ECCU, which accounts for a majority of the total financial assets. Credit unions play an important role in financial inclusion, and you can see now that they account for a significant component of our financial system. We also have other non-banking financial institutions that operate within the ECCU, and they play a special role in risk management. For example, one of the NBFIs that the ECCB would have implemented or put forward is the Eastern Caribbean Partial Guarantee Scheme, ECPCGC for short, which looks at providing partial guarantee and credit support for small businesses. Also, the ECCB looks at strengthening the financial system. We have a few key priorities, which include strengthening the financial system, improving the efficiency of allocation, and looking at how we can develop the region in the long run. So what do we know? So over the last 20 to 30 years, we would have done some trend analysis. When we look at M2 to GDP in the ECCU, we could see that there is strong growth, there is strong liquidity in the system. Private sector credit as a total share of GDP and total private sector credit as a share of GDP has continued to grow over the last 2 decades in tandem. However, we would have noted that under private sector credit, both business and household or business and household credit would have grown together, with the exception of from 2011, we would have noted that following the global crisis, there was a drop in business credit, which over the last 5 to 10 years, we have seen household credit continuing to outpace the growth of business credit. So that's what we knew. What do we know in terms of literature? What does literature say? So we would have looked at the literature based on developing and developed countries relative to Caribbean-specific literature and the ECCU. So within the developing countries, we would have noted that Shumta, McKinnon, and Shaw looked at the importance of financial systems in allocating capital. King and Levine 1997 would have looked at the importance of having well-functioning systems in determining capital allocation and efficiency. But from all of our research and the literature we would have examined, in developing countries, we would have noted that there were mixed results when you looked at the finance growth relationship. So there was, in the early developmental stages, a strong relationship, but with the maturity of the economies, we would have seen that there was a change from a supply driving to a demand following. The lower income countries also recognize a weaker long-run relationship. But when we look at the Caribbean and ECCU context, we would have noted strongly that the relationship, the finance growth nexus, that relationship between those two variables varies significantly based on the variables used and the methods used to examine. So we would have noted from Thompson and Bernard that there was a strong negative and significant impact of liquidity on credit growth. Riley would have noted that Granger causality tests indicate that money and credit aggregates and GDP growth are bicausally related. However, the variables used in several of these studies differ from some of what we used, and we would have noted that the general theme from all of this is that the results are very country-specific and variable-specific. All right, so what has changed regarding finance and growth in ECCU?
All right, good morning once again, colleagues. I'll just take us through some of the empirical aspects as briefly as possible. So what has changed regarding finance and growth in the ECCU? As for our strategy, it was twofold and macro, where we would have assessed finance and growth in the ECCU via panel co-integration and Granger causality analysis. We would have also reported contemporaneous point estimates, but in the interest of time, I'll focus on the first two. In terms of our proxies for financial development as displayed, we have the three primary ones as was replicated from literature, and then we made extensions for the ECCU context, given that private sector, that household credit, makes up a large portion of our private sector credit, and so we would have made extensions to include business GDP, business, and household credit as proxies for financial development within our analysis. In terms of our data sources, we would have collected data from our data repository at the Eastern Caribbean Central Bank. We would have utilized the WDI as well as the Penworld table as a source of capital stock data, just in terms of noting as it relates to the PWT, data stops at 2019, and so as authors, we would have done the perpetual inventory method in order to augment this and get capital stock data up until 2024, which is where our analysis ends. And so first and foremost, we examine panel co-integration to disentangle whether there has been a long-run relationship between financial development and growth over the last 30 years. As a precursor to this analysis, we would have conducted a slew of panel unit root tests. As we know, the LLC, the Bruton, the IPS, and the Fisher ADF. In terms of conceptual framework, our model would have been outlined as indicated here, where we would have tested for the presence of a unit roof within the panel OLS residual. And so to determine whether there's presence of co-integration, we would have applied the Pederoni 1994-04 approach to test for the unit root in the panel residual, and then thereafter we would have made an extension using Westerland, given our unique nuances as a currency union where we have multiple countries. We would have used Westerland to determine whether or not co-integration exists for some countries in the panel, if not all. We move on to Granger causality, where we basically try to disentangle whether financing growth is demand following or supply leading, and so we determine whether historical values of financial development help us predict for GDP after controlling for past GDP, and vice versa, whether historical values of GDP help us predict for financial development after controlling for past financial development. In terms of our framework, it's a two-way fixed effects where we have GDP, well, the growth of real economic output, after inducing stationarity. We have lags of GDP determined by minimizing AIC. We have financial development indicators, the current contemporaneous value and its lags, as well as the matrix of control variables X, which includes trade intensity, our capital stock indicators, as well as our annual percentage change in government expenditure. We also have controls for fixed effects as well as aggregate time varying effects. And so we test broadly using Granger 1969 and conducting, very simply an F-test, whether or not the coefficient of the lag variables are statistically significant. In terms of our empirical limitations, they are a lot. And so we recognize the fact that we have a small sample size in terms of our cross-sectional dimensions. In terms of internal data limitations, which basically constrain our use to some of these more traditional empirical methodologies. For instance, our economic output variables in the ECCU are measured on an annual basis compared to some of the other state jurisdictions that have measures of output on a quarterly basis. And so it limits greatly the econometric methodology that were employed. We also note that proxies of financial development lack qualitative content, as well as the fact that the finance growth nexus does not exist in a vacuum, and there's a need to account for institutional factors, for regulatory reforms over the years and across time. Yeah. Just quickly, in terms of our results, on the basis of Pederoni, which is looking at the panel from an aggregate basis, we only found evidence of private sector credit as a percent of GDP and business credit variables to be co-integrating. However, when we applied the extension, the Westerland test, we found that all of our credit-related proxies of financial development are co-integrated for some countries within the panel. And so it begs the question, or leads us to the conclusion, that despite existing within a quasi-currency board, where we coordinate our monetary policies, some countries have a long-run relationship with finance and growth while others do not. This is just for a brief flavor of how the results of the Westerland test looked. And as we see depth, there's no evidence of co-integration from that point of view. However, for the other credit-related proxies of financial development, we do see evidence of co-integration. In terms of Granger causality, we do see supply-leading Granger causality that's unidirectional, flowing from debt to economic growth as well as business to economic growth, which basically informs and reaffirms the need to focus on the efficient allocation of credit within the ECCU financial system. Simply put, historical values of both financial debt and business sector credits provide useful predictive content for current values of growth based on our empirical analysis. And just by way of summary within our research, in previous literature that was ECCU specific, Riley would have found bidirectional causality, while Thompson and Bernard would have found a demand-driven direction of causality flowing from growth to credit. However, in this paper, we found a unidirectional and supply-leading relationship. In terms of the long-run relationship, Riley would have found private sector credit and real GDP demonstrates aggregate core movements. We would have noted the caveats within our research concerning the Westerland test and how this long-run relationship exists for some countries within the ECCU, if not all, in the case of very few indicators. And for the point estimates, we did find consistency in terms of what was obtained previously. I think this paper positions our research department and the Eastern Caribbean Central Bank in terms of framing our outlook in terms of the big push agenda as articulated by Governor Antoine, as well as understanding how best to influence growth and development in the currency union. And so we would have put together a curated list of things we still don't know and future research priority items. And it includes as follows: country level assessments of finance and growth, understanding that even in the presence of a very integrated financial system, there are country level nuances. And so that's one area we have identified for further research. In terms of micro level assessments of finance and growth, we understand and acknowledge that individual household and firm behavior can shape outcomes in the financial market, and so there's bandwidth for further analysis in that regard. Financial inclusion, or the ECCB, has been doing quite some work with regard to this thematic area. We understand how equitable finance and inclusive finance drives growth and development within our small economies, and so that's one such area we'd want to look into, and not just in terms of access to financial products, but also in terms of relevance, as well as affordability of these financial instruments. Fourthly, we have the use of more contemporary econometric techniques, and this, of course, is contingent on improving our data systems within the ECCU and access to more frequent output data, for instance. And so there's bandwidth under this particular component for the use of more macro techniques and so on. And then finally, one of the areas that is very close and dear to my heart, we believe that there is a need for there to be a systemic reorientation from a focus on finance and growth to finance and development. Because as much we still don't know about the way in which financial deepening impacts poverty, how it impacts inequalities within our societies, we still don't know whether or not there's a need to proliferate gender mainstreamed or youth mainstream financial products within our financial system to basically get the development outcomes that we seek in an effort to transform our ECCU. And so I hand over to you, Naomi.
So we have gone through what we knew, what we saw in literature, what we ourselves would have found from econometric analysis. And we also want to, going into policy recommendations, remember the context of the ECCU. So our policy recommendations are based on the context that would have been laid, the foundation laid within the opening segment of the presentation. It would also be based on our econometric analysis that was found. Part of that, one of the main things that stood out from the results is that it suggests that business credit is one of the leading causes of growth for us in the ECCU. So one of our first policy recommendations is the consideration for encouraging lending to businesses and MSMEs. So part of what we would have noted in our overview of the ECCU is that household credit since the post-financial crisis would be what is leading private sector credit. So the suggestion is being made for us to now look at how we can develop business credit in areas that would increase productivity. We want to look at enhancing institutional quality and governance reforms. Based on the literature, we would have presented a financial institution quality is important in ensuring that you have good economic growth and good financial development. Part of that would also lend to enhancing quality of credit, and finally, strengthening judicial and regulatory systems. All of these recommendations are possible ways in which we could look at enhancing growth in the region based off the results that we would have attained, and we are happy to discuss them further if you have any questions. And with that, we say thank you for listening.
On the discussion for this paper, I call on Dr. Karen Rupnarayan, Senior Economist of the Central Bank of Barbados. They gave her 5 minutes. Comments.
Thank you, Dr. Noel. Good morning, everyone. I really enjoyed reading this paper. It revisits a question many of us debated early in our careers: whether finance genuinely drives growth in small open economies or merely follows it. For the Eastern Caribbean Currency Union, this question remains quite central as the region seeks to double GDP within a decade. The paper is well motivated and methodically strong. It extends the sample to 2024, uses panel co-integration and Granger causality tests, and distinguishes between household and business credit, a distinction that matters in our bank-centered systems. I also appreciate the author's intellectual honesty in noting that the absence of Granger causality does not necessarily preclude a beneficial relationship. Some general comments. In describing the ECCU's financial structure, it would strengthen Section 2 to present commercial banks' share of the total financial assets, not just as a dollar value. The ratio would rather capture concentration within the system. In the limitations section, could be clarified. No, you clarified it. You gave some nuance in the presentation, but in the paper, the phrase reliance on internal data, which may be incomplete or inconsistent, invites questions. Which series were most affected? Is the issue definitional differences across jurisdictions, gaps in time series, or the coverage of business versus household credit? So briefly addressing these would enhance the transparency and confidence in the results. In the policy section, the statement that limited institutional capacity constrains the region's ability to translate financial deepening into sustainable development outcomes is persuasive, but could be tied more explicitly to the empirical findings. For instance, to the short-run association between financial depth and growth, or to the dominance of household over business credit. I also like the call for micro-level research. That is indeed the dream for all of us doing empirical work on Caribbean data sets. To use individual household and firm-level data to unpack why macro relationships vary so widely across our economies. Of course, as you noted, that depends on the actually accessing micro-level data, but it is our dream nonetheless, yes? Linking that ambition directly to the paper's mixed-level country results would close the analytical loop. Just some notes on the methodology. The core framework of panel co-integration, fixed effects, and Granger causality is appropriate, yet 3 refinements could enhance robustness. First, in terms of the cross-sectional dependence, the ECCU economies move together, testing for dependence with Pearson's CD test or using estimators such as the common correlated effects or the cross-sectionally augmented IPS unit root test could offer safer inferences. In terms of error correction dynamics, extending the analysis with an autoregressive distributed lag, the ARDL approach, estimated by mean group or pooled mean group methods, could quantify both country-specific short-run responses and a common long-run elasticity. In terms of structural breaks, the sample spans the global financial crisis and COVID-19. A biparent break test or a threshold model could show whether the finance growth relationship changes signs across shocks, a finding that would connect directly to the paper's narrative on shocks and resilience. Granger causality is interpreted cautiously, which is good practice. But a next step, fully modified OLS or a dynamic OLS estimators could offer long-run coefficients more robust to endogeneity, especially in a small N panel. Finally, the negative contemporaneous coefficients on credit suggest the finance growth linkages may be nonlinear or have a threshold effect, meaning improving only once institutional quality or credit efficiency crosses a threshold. Exploring that interaction using a Hansen threshold panel or just an interaction term between financial development and institutional quality could be a promising extension. In closing, Overall, this is a rigorous and policy-relevant paper that balances empirical analysis with regional insight. My main encouragement is to refine the methodology for common shocks and heterogeneity, clarify the data limitations, and connect the institutional narrative more tightly to the empirical results. In doing so, the study can move beyond just asking whether finance causes growth to explaining how the quality and structure of finance determine the pace and inclusiveness of growth in small integrated economies like the ECCU. Thanks.
Thank Dr. Karen Rupnarine for that. Thanks for that comprehensive comments on the paper. I urge you to share your comments with the authors. I think that is will be useful and valuable. Just before I open up the floor to questions to the presenters, do you have any questions or comments on what was just relayed to you by the discussion? No? Sure, Mark. You're going to get a comment at the conclusion of this session, hopefully, Karen. So let's open up the floor for some questions to the presenters. Please, if you're going to ask a question, please say your name and your organization for the record.
Good morning. I'm Darren Downs. I'm from the Central Bank of Barbados. Now, I like how the presenters actually end the paper. I mean, I like the fact that you have to think, I think, more about that financial deepening, the traditional view of what financial deepening is, or financial debt. The work by Levine and others was done in the 70s. Private sector credit to GDP. I don't think that, it is really that relevant. I mean, it's a start. You've done that analysis and you can rule that out as a measure. Because if private sector credit to GDP is increasing, it may have balance of payments effects that may have a negative feedback on growth. So I like the fact that you have some questions at the end that will allow you to go back and reassess, how you really think about financial deepening within the context of the ECCU. I mean, all of our economies face these binding structural characteristics that we can't get away from. And I think we have to really look at measures that really reflect our reality. And also I would add to Karen's comments by looking at some nonlinear models, because the relationships among these variables are not necessarily linear. So think about some nonlinear models that can better capture the relationship. Dorian, I'll stop there. I could speak to the authors afterwards.
Yes, well, thanks.
I'll keep the time.
I'm a bit concerned. Any response? Presenters? It's more comment more than anything else than a question, right? Am I Darren? Yes, sir. Yeah, sure.
Okay, thank you for your contribution, for the comments. We appreciate any feedback in terms of how we could strengthen the paper, and it is something that we'll consider. We could also have a conversation after for the sake of keeping to time. Thank you.
Any further questions? Yes, please.
Thank you. Andre Murray from Bank of Jamaica. I want to first commend the presenters and the reviewers for an interesting presentation. And I'm a bit curious about that graph you showed with the trend in M2 versus the total GDP growth. It raised the question in my mind, what caused the difference in that trend after that 2011 period? It's important, I guess, to figure out what caused that change in trend when you're particularly trying to do long run relationships. And if you do find that that change in trend was the introduction of maybe some new financial innovation, maybe growth in the non-bank sector or the credit union, etc., that shift could perhaps allow you to maybe apply some difference in difference to strengthen the research and get some more causal inferences. So I think it would be interesting to explain that trend and see if that can actually add some value to your research.
Do you have a response, a quick response?
Thank you so much for that. I do believe that extending it to actually from range causality to the definitive framework to disentangle some causal effects would be well received in terms of the paper. So thanks for that.
I'm being told that this first presented paper has run this course is 20 minutes. My clock said we still have about 3 minutes, but I will take it from those timekeepers. So let's give the presenters a round of applause for a well-presented paper.